Shell CPI report, maybe the most important of the year, different ways to measure inflation, and why today's market is the opposite of the GFC. Today is Wednesday, July 12th, 2023. I am Byron Lazine, and the hot sheet starts now. Okay, maybe the most important inflation report of the year, or even since inflation has started to go up. The Consumer Price Index report was released this morning, and I'm going to go through the entire details with you here today. Let me know as you jump into the live stream which market you are tuning in from, and let's jump right into CPI index for all urban consumers. The index for shelter. Okay, so top line of the report from the Bureau of Labor Statistics, U.S. Department of Labor. Top line of the report here says the index. Oh, sorry about that. Oh, there we go. The index for shelter was the largest contributor to the monthly all items increase, accounting for over 70% of the increase. Okay, so we did have an increase in June. It beat expectations. June increase was 0.2%. So we had an inflation rise of 0.2% in June. It's less than expected. Consumers are getting a break from price increases, but 70% of that 0.2% increase jump in June was made up in shelter. Okay, we're going to get into what that means. If you've been following the hot sheet along for the last 3 months, you might already know what it means, and I'll jump into what it means. Let's just go through some of these top line numbers. CPI increased 3% from a year ago, lowest level since March 2021. On a monthly basis, the index rose 0.2%. All right. So we beat expectations, which we were supposed to come in at 3.1% on inflation. We came in at 3. We were supposed to come in at 0.3% for June. We came in at 0.2%. Beating expectations on CPI and inflation is an amazing thing right now. We don't want to be on the other side, right? Doesn't mean that this is necessarily a trend that we're going to keep beating expectations, but you don't start a trend without having a good report. Stripping out volatile food and energy prices, core CPI rose 4.8% from a year ago and 0.2% on a monthly basis. Consensus estimates expected 5% and 0.3%. So on core CPI, that's the one that they really look at a lot. The Fed looks at that quite a bit. We beat both of those numbers on expectations. In sum, the numbers give the Federal Reserve some breathing room as it looks to bring down inflation that was running around 9% annual rate at this time in 2022. 1 year ago, we were running around 9% on an annual rate, which was the highest, of course, since November 1981. Let's dig into the report here, and I'll go through really line by line. If you're interested in anything specifically on the report, you can certainly just put it into the comments and I will go to that industry. 1 month change there is 0.2%. Of course, we only had a 0.1% in May, but it's really that year over year number jumping down that looks really good today. And I've got some of these charts and everything carved out for you, so they're easy to grab over in BAMX. Okay, so you can see here, shelters, the highest number to the right, unadjusted 12-month ending in 2023. Or I'm sorry, transportation is shelter and transportation services making up the highest number there on the unadjusted 12-month. But we've got a different way to look at this. And so let's go to those numbers here. Okay, so let's go right to shelter. You can see that shelter makes up 34.67%. Here we go. 34.67%. It's that number right there. That's how they weight inflation. So over 1/3 of inflation is is shelter. Okay. And so if we go over here to the month over these numbers on the right will be the month over month numbers. So we came in at 0.2% overall on inflation month over month, beat expectations by 0.3. And then for these different categories, we'll take a look at where we're at for month over month. So for shelter, we came in at 0.4%, but that is showing signs of improvement, 0.6% last month. Okay. If we look at rent of primary residence, 0.5%, still hot, flat with last month at 0.5%. Owner's equivalent rent of residences came in at 0.4%, down from 0.5% last month. Owner's equivalent rent of residences. This one we're going to dig into. There's a Wall Street report that came out this morning that we've been talking about on the hot sheet for 3 months. We've been talking about it since April, how much of a scam to the American people this category is, which makes up over 25% of inflation. Owner's equivalent rent of residences. This is that survey that the government does where they call homeowners. It's been going on since the 1980s. They haven't changed it, even though we have real data on rent.com, apartments.com, on Zillow, on Redfin, on Realtor. We have all this real-time data that rent has turned over, yet we want to use the rents owner's equivalent rent of residences survey. It makes up a quarter of inflation. And remember, at the top of the report here, if you're just tuning in, the top of the report from the Labor Department said that the index for shelter was the largest contributor to the monthly all items increase, accounting for over 70% of the increase. With the index for motor vehicle insurance also contributed. So motor vehicle insurance is also something coming in very hot. But because we're using this outdated look at shelter, owner's equivalent rent of residences, where you just got home. I mean, by the way, if you have a house phone and you're able to take a phone survey from the government, you got no idea what your house rents for. I've said this before. It means you've lived in your house probably 20 years if you still have a house phone, and you have absolutely no clue what the heck your house could even rent for. And so this is making up too big of a share of inflation. We're going to get into that Wall Street Journal report that shows us if this was an accurate number, where inflation would be today. We're going to get into that. But first, let's just dig a little bit more into this report. Transportation services. This was a good number overall. Transportation services came in hot last month at 0.8%. It's at 0.1% today for the month over month for the June number. Motor vehicle insurance. This one continues to be a problem. Motor vehicle insurance is at 1.7% for the month. It is down a little bit from 2% last month. Now, motor vehicle insurance being up over 1.7 or being at 1.7% month over month, and 2% last month, 1.4. These are all hot numbers, right? You've got, I think, what is that for the year? You've got 16.9% on the year for motor vehicle insurance. If you live in places like Florida, then you know what I'm talking about there. Maintenance and repair was high this month at 1.3% month over month. Airlines was the big win, coming in negative 8.1% for the month. Apparel coming in flat 0.3%. And new vehicles came in flat. New vehicles at 0. So new vehicles are flat. And then used cars and trucks. This was another big win, negative 0.5%, where last month it was up 4.4%. So finally, used cars and trucks are coming down. Maybe more people realize there is an Uber app. I don't have to go buy a used piece of junk. And remember how crazy used cars got during the last couple of years? People were just like scooping up used cars like they were condos and houses. It was insane to me because that's a depreciating asset. I didn't realize. I sold a car during that time frame because I'm like, if people are willing to pay more than what I paid for this car when it was brand new, yeah, take it off my hands, please do that. Alcohol coming in flat in June, surprising. we get into summer, I thought maybe alcohol would be popped up there. Tobacco and smoking products down to 0.1%. And let's take a look at some more of these here. Energy was up 0.6%, but it was down big last month at 0.36. Energy is the big one for the year, being down 16.7%. Energy's the big help here for the year. If we go up to labor departments, they don't have that chart in here, but you see energy is one of the biggest wins for inflation for the year. Food came in at 0.1%. Food at home is flat. Food away from home here actually lower than last month, which is a little bit surprising, but not surprising that it's up 0.4% month over month. So those are just some of the headlines there on the inflation. I did carve out this section here, kind of gives you a little bit of a breakdown that's down below in the daily download for you that shows some of these main categories. It's got the new vehicles, the used car, the apparel, the energy, food away from home, all of that available for you. And it shows you year over year all the way to the right. So that's down below if you want to grab that slide. Okay, let's get into the Wall Street Journal report from this morning, which validates what we've been saying. So inflation, great news today. We need more great news. How much the Fed and the FOMC is going to take this into consideration when they meet July 25th and July 26th remains to be seen. We just don't know. We don't know what's going to happen the next couple of weeks either. But this was a huge win in the fight against inflation. Now, Wall Street Journal, hopefully, James McIntosh's piece from 8:42 a.m. this morning gets over to the Fed, because we know the Fed hasn't been watching the hot sheet, because we've been saying this since April when I've been sharing this in the daily downloads a number of times. This is an April screenshot from CNBC. Barry Sternlicht, Starwood Capital, chairman and CEO. You've heard me talk about him a bunch of times. He controls 125,000 apartments across America. He models this out for the country. And he was showing us back in March, back in April, that actual rents were declining. We've now seen a number of reports backing that up, whether it be Zillow or Redfin or apartments.com or rent.com or realtor.com, showing us that rents have turned over. There are a few pockets, there's a few pockets in the Midwest and the Northeast that rents are continuing to go up, but overall rents are coming down. Overall, when you look at how much inventory in the apartments are coming on in quarter three, quarter four, you could forecast out that rents are going to come down even more. So this was something obvious to people looking at real-time data back in March and back in April. But the Fed continued to look at the report, the owner's equivalent rent that we just went over. It's how they calculate inflation. It's a 1980s outdated way of doing things. That's what they continue to look at. All right. Now, Wall Street Journal, James McIntosh piece this morning states that if we measured inflation differently, then inflation would be behind us. Okay. Investors who think that underlying inflation is falling but not fast enough for the Fed should be troubled by an alternative measure of price increases. And if we only did it how Europe did it, I don't know if we say that about too many things, but if we measured inflation the way Europe does it, inflation would technically be behind us. If core inflation came in at just below 3%, remember that core inflation number was 4.8% today, still beat expectations that were supposed to be at 5%. The Federal Reserve would breathe a huge sigh of relief. Stocks would head to the races. By the way, they're heading to the races right now. They were in the pre-market. Let's just take a look. So this came out obviously before everything. Yeah, stocks are headed to the races right now. You've got Dow up almost 1%, S&P up almost 1%, NASDAQ up over 1%. So they're all off to the races just off of this report. But if you measured it correctly, they'd be really off to the races. And this isn't merely a dream, states the Wall Street Journal. Measure U.S. price changes the way Europe does, and inflation was already there in May. We were just below 3% on core inflation a month ago. That means we're close to the 2% target today after today's report. The way Europe calculates inflation Remember, the Fed wants to get to 2%. We're basically there right now. The Fed's report that, or I'm sorry, the um, labor statistics report that came out today, just to go back to it really quick. Remember, the inflation increase today that is being reported is 0.2% increase in June. The index shelter was the largest contributor to the monthly all items increase, accounting for over 70% of the increase. Okay, so how does Europe calculate it, and how is it different from how we're calculating it? Well, it comes down to that owner's equivalent rent that I was talking about and have been talking about since March and April. Okay, right now, measuring US inflation using the two different methods. Okay. So, Bureau of Labor Statistics calculates American price rises, um, and, and, and in the way that they're doing it, right? We showed that. Um, and then Europe's doing it a different way. Okay, so US core inflation, which excludes volatile food and energy measured using the standard consumer price index, was 2.3 percentage points higher than the European style inflation, known as the harmonized index of consumer prices. It is the biggest gap that there has ever been, this 2.3% gap between what Europe uses, which is the HICP, the harmonized. It sounds better too. A lot of sounds very inviting. The harmonized index of consumer prices. The main reason is that Europe's measure, the HCIP, doesn't include the imaginary cost of what a homeowner would pay to rent their house. Okay. So if you were to pay to rent the house that you lived in, and you probably lived there 20 years because I'm calling you on your house phone, what would the imaginary cost be? Like, pull a number out of your head. And everybody thinks their house is going to rent more than, if I were to rent my house out, what would I rent it out for? Everybody's got a higher number in their mind until they meet the market. I certainly do. I had a number in my head for a property I'm going to be renting in Naples in the near future. And then I look at what's going on with the inventory increases in rent, and I'm like, yeah, I'm not getting that. I'm not getting that. But if you asked me, if you just surveyed me, yeah, I'd spitball out some ridiculous number. All right. So the HCIP in Europe, they don't play make believe. They don't play pretend with this imaginary number in housing that makes up a third of the US core CPI. We know it makes up really 25%. Overall shelter makes up over a third, but we just looked at it. Owner's equivalent still makes up a big chunk. It makes up a quarter. It makes up one quarter, 25%. It's known as owner's equivalent rent or imputed rent. The measure has long had its critics. Barry Sternlight is one of the big critics. That's where I really learned about this scam the beginning of this year. I'm like, wait a minute, really? That's how we're doing it? So exclude something that no one actually pays. Nobody pays that. It is an imaginary number, and which is calculated from guesses by homeowners of the rental value of their house. And core inflation is looking basically fine at a fraction under 3% after today's report. Okay, after today's report, that number is probably closer to the 2% target. I've concentrated on core inflation because food and oil prices swing so much that they make it hard to tell if the economy is generating inflation pressures the central bank needs to tackle. So the reason everybody's so concerned about inflation, according to this piece by James McIntosh in the Wall Street Journal, is partly about biases and partly about change, but it's mostly about worries that the economy is running too hot to be confident that inflation will come down to the 2% target. The bias at the CPI is long established and widely used in the U.S. The Bureau of Labor Statistics produces its own HICP inflation data as an experimental measure. Many economists and investors don't even realize that this is available, that looking at it the way Europe looks at it is available. To make matters even more confusing, CPI gets almost all the focus. You're seeing all the headlines today wrapped around the CPI. And while the CPI data is good, it's not taking into consideration this HICP, which would show it at a 2.3 percentage points lower. Okay, so you're taking that 4.8% core inflation and carving out 2.3 percentage points from that. Okay, to make matters even more confusing, inflation-based target on the personal consumption and expenditures, PCE, also another one we pay a lot of attention to from the Bureau of Economics Analysis. PCE comes in lower than CPI, but still puts large weight on imputed rent that actually isn't paid. So the PCE has this imputed rent, this imaginary number that's actually not something that's being paid, as well as the CPI. So even if the Fed thought ICP was better, Europe's model, and there is no signs that it does, there's no way it could change the measure without drawing political heat. They're not going to listen. Basically, the problem we're in, I think we got to get past these inflationary times before we can go and change the measurements. Because if the Fed were to come in, or anybody were to come in and say, hey, let's go change the way we calculate inflation now, they're going to be saying, hey, you're trying to make the numbers look better. You're trying to cook the books for, one political party to stay in office, or vice versa. Right. So they can't go changing, especially as we're coming into 2024, a potential election year. They can't go changing it now. But why don't we just all acknowledge that we're in a very strong economy? And how do we get better at fighting inflation? If housing makes up this much, if shelter makes up this much, we take a conscious effort, government take a conscious effort to making sure we get more inventory. Okay, this is what the American people care about. They care about a good place to live that they can afford. So if we can get more affordable inventory onto the market, it's happening with apartments right now. I mean, I would argue whether some of this stuff's going to be affordable that's coming out quarter three, quarter four, but there's at least more inventory coming on, which is going to pull prices down naturally with this competition. If we can get more inventory on in housing, that's going to be a big deal for the American people. Overall, it looks like inflation is doing a lot better than what a lot of the skeptics are saying. We need more months of this type of information, certainly with the CPI, because that's what they look at for this to become a trend. But housing right now is making up a significant difference on inflation. The HICP, which Europe uses, which I referenced here in the Wall Street Journal piece, gauge excludes imputed rent for homeowners, and it's much, much lower. You can see here that they are below core CPI minus core HICP. They are much, much lower than the 3% that we're at right now, just above the 2. And then if you go core PCE minus HCIP, it's under 2%. These are crazy numbers. These are numbers that we would want to be at right now, and we could be at if we didn't play imaginary land. Certainly, if you've been a consistent listener, either afterwards on the podcast on Apple or Spotify on the hot sheet, or live in the mornings here on YouTube, then this to be true. We've been talking about it. I'm glad to see that the Wall Street Journal finally reported it this morning, because it's not, we're talking about it here. We're a small little niche in the real estate industry, small little corner of putting information out. But you've got big players like Barry Sternlight, who I've talked about a bunch here, who's been saying the same thing for quite some time. You've got rent.com, you've got apartments.com, you've got Redfin, you've got all of these reports that are saying the same thing. So it's about time that we start to acknowledge them. All right, let's acknowledge the other fact that not enough people are talking about. And Bloomberg did a great job of reporting this yesterday afternoon. Everything is the opposite of the great financial crisis. Everything. And I would say the one thing that's the most opposite of the great financial crisis is our housing market. Okay, so what are they talking about? They're talking about equities are fully priced. It makes sense to start with equities since earnings seasons is here. And equities are fully priced, but equities in the run up to the great financial crisis, stocks were still recovering from a 2000 tech bubble bursting. Valuations were lower than they are now. with an average price forward earnings ratio of around 15x at the public's peak in 2007, according to these figures. Okay, so you've got equity stocks in a much different place than financial crisis. Number two, they say a no Chinese pick me up. Okay. When the global economy collapsed in 2008, the Chinese played an important role in filling the global demand gap. The Germans, for example, even after the great financial crisis, of course, of 2008, had been relying on the Eurozone's for export demand to make up for their anemic domestic growth. When the European sovereign debt crisis hit, they were able to pivot from Greece, Spain, and Portugal to China and keep the economy growing. The Chinese are certainly doing their best to keep growth up, but we know that they've had some issues right now in their economy, but it's more of a band-aid of property debt relief after a run-up in property prices and the kind of bubble inflation that cost Japan heartburn some 3 decades ago and caused U.S. similar balance sheet recession angst after the GFC. Overall, the Chinese economic reemergence after COVID has been underwhelming relative to expectations. Okay. And then you've got a wild card here in commercial real estate. The difference right now between a normal recession for the financial sector, like the one after the internet bubble, and one that's like the SNL crisis, will probably be commercial real estate. I agree with that. I would 100% agree with that. I think when you talk about real estate, housing is not in the crosshairs. Okay. We're well below foreclosure levels that were pre-pandemic in normal times. So we're in a really strong place with housing. Many Americans own their house outright. Many of them are sitting on 2-3% interest rates. We don't have a problem with housing. We have low inventory. The only problem we have is that if prices run off again because of how low the inventory there is. But when you look at commercial, and since regional banks are holding all of these CRE loans, how much of a hit are they going to take in the downturn? I spoke about this even yesterday. You're going to see organizations try to basically renegotiate their leases at the same time these buildings are going to have to refinance their properties. And so that is the big wild card. Is commercial real estate big enough to create a great financial crisis type of movement, because it trickles into regional banks, and then it trickles into city taxes, like New York City, 20% of their taxes are from office buildings? That remains to be seen. I can't figure that out. Maybe it's big enough commercial real estate, and it's a big enough collapse here that it could turn into something like that. But everything else, essentially every other measurement that we're looking at, would be the opposite of the great financial crisis. It's just a good piece from Bloomberg that I want to bring to your attention. Also like to bring to your attention that we've got good news. We've got really good news on the 10-year. Look at the 10-year. We're just sitting up over 4, recently here. And now we're at 3.904 to start the day. You can see the sharp decline from 395, over 395, down to 390, even touched below when that CPI report came out this morning. So the 10-year being down is really good news to see where, if we can get some relief on the 30-year. We had a little bit of relief yesterday, down 0.03% to 7.09. Love to see like a big old drop down to 699 today on Mortgage News Daily survey on the 30-year fix. That'd be amazing if we could get there with where the 10-year is today. Okay, that is your hot sheet. Love for you to join me into BAMX, doing a mastermind on Friday. If you're a real estate agent, this is a halfway year mastermind on Friday. Of course, we have all our courses, live streams, all the daily downloads consistently from the show in the private Facebook group. Get into the hot sheet, or get into the hot sheet downloads by getting into BAMX. It's down below. And I'd love to see you on that mastermind on Friday if you're a real estate agent. We're going to dig deep on what you got to do for the second half of the year to hit your goals or exceed goals. Appreciate you tuning in. Until tomorrow, have a great day. And of course, toodaloo.